The other day, we did a what if scenario with Taylor from Life Goal Investments, a 10-year Wall Street veteran, on what would happen if the U.S. defaulted. What I want to do here in this what if scenario is talk to the one and only Anna Kelly about what happens if unemployment spikes to 10%, let's say within a 6 month window. So really does spike and spike quickly. Let's say that we are in a recession where quarterly GDP is down -2% quarter after quarter. So we are in what I will call, without question, a hard landing. This is, again, is just a
Yes.
what if. I don't think, I'm certainly not forecasting that as my base case, but it is possible. So I
Yes.
wanted to talk to Anna about, hey, if we hit a hard landing and it is hard, what might be some things that we see? So Anna, we got to talk about it. It's 10% unemployment. Hard landing is here. What's
Yeah.
going on? What do you think happens?
Well, in terms of for rental properties, you're going to have vacancies start to go up, and you're going to start to have collections go up. So you're going to have people that are simply going to lose jobs. It's going to take them time to file for unemployment. Some of them may get unemployment, but not nearly as much as what they were making before. And so you're just going to have some tenants that have been good quality tenants that start to struggle. They break leases, they move back home with their parents. Maybe they make, small trickle down, payments, but you're going to have a little bit of a cash flow problem. And so
Yeah.
you're going to have to really be prepared for that and to have reserves so that if those tenants aren't paying, you can still cover your debt service and all your expenses of the property.
Yeah, there's no question. Having gone through an environment, where unemployment spikes, obviously the pandemic, I think it went to 13 or 14%. Not that one, but the Great Recession and the dot-com crash, right? I was investing through all of that. You're right. Collections will become an issue first, then vacancies. It's an excellent point. One of the things I want to go to that will infect the economy is, I think if we spike to that, the Fed cuts rates probably back to the zero bound, right? If we got 10% and, a hard landing, if we don't go to zero, we probably go to two, and we're currently at five. So I
Right.
think rates go down pretty quickly if that happened. Do you think that's reasonable?
It's really interesting because again, every economy is a little bit different. The things that put you into recession are different each time. And right now we're still seeing some sticky inflation numbers. And so, I think typically if you look back at recessions, when you have a recession, it's usually about 6 months into the recession before the Fed really starts to cut rates. And so
Yeah.
it could still take a little bit of time. So if they're kind of battling unemployment at the same time that they're battling inflation, I think that they could cut rates more slowly and do it kind of stair stepped and
Okay.
bring it down to try to not let inflation rear its ugly head. Because if they cut too quickly or back to the zero bound, Michael, then they're in a real stagflation environment where you've got
Yeah.
inflation happening at the same time as deep recession. They're trying to avoid that. And so
Yeah.
I think they cut rates. They have to. It's the only way they really stimulate the economy again, but I don't think they go quickly back to the zero bound. So I think you're still going to have, 6 months for sure of pain if this happens, up to, a year before rates really come back down and give a little bit of breathing room.
Yeah. Yeah. So the other thing I wanted to ask you about is, um, commercial properties, specifically multifamily and office for that matter, really could see even more problems, right? If or if rent collection goes down and costs go up, that could really impact the NOI and even hurt the values. We've heard about properties going back to the banks and being sold for discounts. If this happened, in the next 6 months, this certainly wouldn't make commercial properties more valuable. It would probably hurt values even more, I would think.
Yeah, it's really interesting. So because I play in the commercial multifamily space and it's what I do,
Mhm.
the majority of my time, I research probably like no other, in terms of history and what happens and how do we hedge. And essentially commercial values are the net operating income divided by a cap rate or a going rate of return that investors expect for taking on that level of risk in an investment compared to like a US Treasury or a bond or the stock market, right?
Mhm.
So when you have a hit to your cap rate and values are starting to go down because cap rates are going up while interest rates are going up, then the way that you keep value is you make sure your net operating income is really, really good. So if you have a hit to your net operating income at the same time that you have a hit to your cap rate, it definitely can depress values. The thing that can kind of balance things out is right now incomes and rents are really able to counteract some of the growth in the cap rate. If interest rates are cut, multifamily is going to be a flight to safety investment again, because they're typically recession resilient if you're in an area that allows you to keep that income really high. And so one of the things that I do is I only invest in Class A to B markets where there's a lot of jobs, job diversity. And so that if people are losing jobs, they can quickly find another job. So if you're invested in like a Class A to B area, I'm going to say Houston, Texas, Dallas, Texas, Raleigh, North Carolina, Atlanta, Georgia, for example, you have a lot more plentiful and diverse jobs. You might not see a whole lot of pain, to be honest with you. And your
Nice.
renters are going to want to rent there because they want to be near good jobs. But if you have Class C workforce housing in an area where there's a lot of supply or it's rural and there's major job cuts, you could have major changes in your values and your rental income. And so, location, 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 it makes a big difference into how are you going to fare if these things happen.
Yeah. The one thing that I go to in all of this, right? Roughly, I think it's 66% home ownership. Let's call it 65 for easier math. If we go up from 3, 4 to 10% unemployment, that's like 7 or 8 million more people unemployed.
Right.
That's probably 4 million homeowners. So the big question I would have is you and I have experienced kind of two different reactions from banks, right?
Yes.
In the Great Recession, everything was a CDO. They didn't know who owned what. So you had to foreclose to kind of clean up the paperwork. And that obviously was a disaster. In
Yes.
the pandemic, what we saw is forbearance with a click of a mouse. So if we
Right.
do spike to 10% and people now can't pay their mortgage, let alone rent, do you think the banks bring back forbearance for a window, or do you think they go the foreclosure route or short sale route? Because again, they've tried both. Which one do you think they try in
Right.
this instance?
I think because we're in this era of post-pandemic, and listen, we still have situations where there's eviction moratorium still in certain cities, right? Or judges have a huge backlog, and lenders are the same way. So I think if the left gets its way, they're going to say, wait a second, we need to put in another national emergency and tell banks that they have to work with people that they can't foreclose, and tell landlords that they have to not evict and wait for people to, get their unemployment paperwork or whatever. So I could see a case where that happens. I think banks are going, because banks are really struggling, and this is what the challenge is. Banks are struggling, and if they have to write off mortgages, they're going to reduce their assets on their balance sheet at the same time that people are pulling money from banks, and they've got a lot of debt. And so, the fact that we have potential risk of a banking crisis at the same time in this scenario that you have really high unemployment, banks are not going to want to work with you. They're going to say, I don't want to work with you, but at the same time, I don't want to write off the asset. So they're hoping there's some kind of federal backstop that says, hey, you've got a federally backed mortgage. We're gonna help you out. So it'd be real interesting to see what happens. I think that they would be slow to do the foreclosures and write down the assets, but they're certainly not going to be happy to be working with you.
Yeah. And the other thing I think that's going on out there is banks with bigger loans would do what's called extend and pretend. I think it's really interesting when you look at office, and we're already seeing some numbers go through, like 350 California Street in San Francisco went for like 80% off. There's an
Wow.
LA County went down. It's pretty bad out there. But it's really interesting because again, commercial banks need cash. So
Yes.
we're already seeing, right, with the SLOOS report, Senior Loan Officer Opinion Survey, that tighter credit, there's going to be tighter credit all year, less demand, all of that. We're going
Yes.
to see a lot of operators, I think, where they thought the bank was going to just refi it because the term's up. The bank's going to say, sorry, I need the cash. Go somewhere else, or do a massive cash in refi. I think there's a
Right.
lot of interesting choices coming.
Absolutely. And if you look back in history, you'll see that anytime that there's a deep recession, the banks tighten up. They make it really difficult for anyone to get a loan that's not already really high quality, lots of liquidity, lots of assets. And so it's harder and harder to get loans, much less refinance loans. And with everything else, again, going on in the banking crisis, banks are really struggling compared to sometimes banks, your big banks, they're in a good position during a recession. And so, they're fine with writing off some debt. This is going to be, very, very challenging for anyone who needs to refinance debt for sure.
Yeah. So I guess we'll kind of wrap this up. Do you, on the scale of 1 to 10 or 1 to 100, whatever is your option, what do you think the chances are we see a 10% unemployment rate in the next 18 months?
Maybe 30% that it goes
Really?
that
That
high.
that high? Wow. That's amazing.
Yes.
I love that we
The,
disagree. That's awesome.
but again, this is like hypothetical, right?
Yeah, of
The
course it
the
is. Yeah,
the
yeah.
only way, that I see this happening is if we have some other financial crisis, right? We have a banking crisis. We start to have banking collapses. There's fear in the markets, there's fear with people, there's fear with corporations. Or we God forbid, get sucked further into war, right? Those
Sure.
kind of things can cause very rapid spikes in unemployment. I don't think your 10% number is, yeah, that's pretty high. That
That's
takes
pretty
a pretty
high.
major
That's a
crisis for
big
that to
one.
happen. So, maybe 30% is even high. If you just said a hard landing and
Oh yeah.
unemployment going up to 5, I'd
Oh,
probably be back up in the 50% range. I think it's much
yeah.
more likely, that we have a hard landing with higher unemployment, but 10 would be pretty deep. I mean, it's almost
Yeah.
a depression type of unemployment. So,
Yeah. Yeah. That's
yeah.
kind of where I'm at. I think 10's just a psychological number because it's double digits. I think the chances of seeing a 10 in 18 months are less than 5%. But if you said
Yeah,
7%, which is a double, which is significant, that's
right,
probably greater than 50%. Right. So
right,
it's just
right,
that it's that range. So it's pretty
right,
wild.
exactly,
Anna,
exactly.
where can people find you?
Great. You can find me here every week on your show, and you can find me on social media at Anna Kelly REI Mom, and reimom.com is my website for coaching and consulting.
Awesome. Do me a favor, folks. Go check out our website, say hi, and let her know you came from one rental at a time so she knows her time is valuable here. Thanks, Anna.